Assalamualaikum, my name is Farah Nushamira and I will start with the introduction. To begin, Public Bank is the third largest bank in Malaysia. As of 2024, it has a total asset size of 542.86 billion and a market capitalization of 88.51 billion ringgit, making it the second largest company listed on Bursa Malaysia. The bank operates 472 branches across Malaysia and has a strong presence in 13 countries internationally. Public Bank complies with BNM regulation and adheres to Basel III guidelines to ensure financial stability.
The board created the Risk Management Committee, which consists of 8 members, and 5 of them are independent directors, including the chair. Jasmine Loh Sotleh has been appointed as Chief Risk Officer in Public Bank in 2016. The role of the Risk Management Committee is to support the board in overseeing risk management and internal control.
Like any major financial institution, Public Bank faces a wide range of risks, including credit, market, liquidity, and operational. To manage this effectively, the bank has established a strong governance structure. The board of directors is supported by a risk management committee who oversees the bank's integrated risk framework. The group's risk management framework sets out the principle applied in managing the material risk that the group is exposed to. The framework serves to drive the development of a consistent risk management practices which enable the continuous identification, measurement, control, monitoring and reporting of all applicable and material risks, and this includes the continuous identification of emerging risks followed by the assessment of the risks on the group's business and capital positions. The group's risk limits established to manage the size of the risk exposures are aligned to the overall risk appetite.
Now, let's review the key risks for Public Bank. Firstly, Public Bank mitigates credit risk through various methods such as credit policies, independent credit control and others, resulting in a low risk level and stable status. Next, for market risk, mitigation includes hedging strategies, risk limit and others, leading to a medium risk level and stable status.
Liquidity and funding risk, Public Bank has implemented 4 key risk mitigation strategies. First, it set risk limit and early warning indicator to monitor and manage potential liquidity risk. Second, the best a comprehensive contingency funding plan to ensure it can meet obligation in time of stress. Third, it maintains a strong liquidity buffer to provide financial flexibility. Finally, these measures are supported by well-defined policy and guidelines to ensure consistency and reliability in risk management. As a result, the risk level remains low and the risk status is stable. For operational risk, Public Bank has implemented key risk mitigation strategies, including a robust system of internal control, business continuity management, which is BCM, insurance coverage, and regular review of outsourcing arrangement. These measures help manage both internal and external risks. As a result, the risk level is medium and the risk status remains stable.
Okay, I will present a review of enterprise risk management practice focusing on 3 key risks: technology and cyber risk, capital risk, and reputation risk. First, technology and cyber risk arise from IT system failure, cyber breach, and all human error that could lead to financial loss, disruption of the service, or reputation harm. The impact cover a financial, manufacturer, and intellectual capital. To manage this, government structure are in the place to ensure system reliability and resilience. This risk considered high and increased. However, it also creates opportunities such as strengthening customers' trust, driving digital innovation, and improving efficiency. Next, capital risk refer to insufficient capital to support a growth strategy, meet regulatory requirements, or manage the risk profile. The impact are mainly financial and intellectual capital. Mitigation includes capital monitoring, stress testing, and recovery planning under ICAAP. This risk is medium and stable, and a strong capital management and can build a resilience, support expansion, and attract an investor. Finally, reputation risk come from negative shareholder perceptions that may affect a business relationship and funding. This impact a financial, social, and intellectual capital. Mitigation involve credit policies, monitoring, and setting limits. This risk is medium and stable, while effective reputation management build trust, loyalty, and competitive advantage.
So next is strategic risk. Strategic risk is the possibility of internal or external event that may challenge the group ability to achieve its objective. So it can affect financial capital, manufacturing capital, human capital, social capital, and intellectual capital. So to manage this risk, public bank review plan regularly, strengthen strategy oversight, and monitor target closely. So at the same time, the strategy planning build resilience, enable quick adaptation, and enhance long-term sustainability and shareholder confidence. The risk level is medium, and the risk status is stable. So next is Sharia non-compliant risk. Sharia non-compliant risk is the risk of financial loss or reputational damage if the bank fail to comply with Sharia ruling and standard from regulator or its Sharia advisor. They mainly impact financial and intellectual capital. Public bank mitigate its through risk limit, early warning indicator, and contingency funding plan, liquidity buffer, and clear policy. Opportunities include using its strong deposit base for safe loan growth, expanding digital deposit product through MyPB and mobile banking, and channeling surplus liquidity into green finance. The risk level is medium and the status is increasing. So next is compliant risk. Compliant risk is the risk of failing to meet legal and regulatory requirement, which may result in restriction. It affects financial, manufacturer, human, and intellectual capital. Public bank manage this risk through internal control, business continuity management, insurance coverage, and review of outsourcing. So opportunity includes investing in digitalization and automation, enhancing cybersecurity and fraud prevention, improving climate risk response such as flood resilience, and applying proven framework overseas. The risk level is low and the status is stable.
For the risk control and self-assessment, Public Bank has rated climate risk as high. The justification is that climate change brings more frequent extreme weather events which can affect borrowers, lower asset values, and create pressure from regulators and investors. To mitigate this, the bank is strengthening its framework, integrating climate risk into governance and promoting green financing such as green property loans and sustainable investment. On the other hand, insurance risk is assessed as medium but high in importance due to the bank's expansion into general insurance. This increases exposure to underwriting risk, claims volatility, and stricter capital requirements. The mitigation plan includes strong capital adequacy monitoring and the use of reinsurance protection, which helps the bank manage large or unexpected losses effectively.
Let's now focus on the risk forecast for 2025. Firstly, credit risk is forecast to have a score of 3, which is medium for both probability and impact. Why? This is because Public Bank has shown good performance in 2024 with a low impact loan ratio and high loan loss coverage alongside strict lending standards. However, the forecast reflects a likely increase in economic pressure in 2025, such as inflation and subsidy rationalization, which may lead to a higher loan defaults. Next, market risk is forecast to have a score of 4 for probability and 3 for impact, which result in a high risk level. This is because Public Bank admit that market risk is always uncertain, especially given geopolitical tensions, economic instability, and foreign exchange fluctuations that are expected to persist in 2025. This uncertainty leads to a high probability for market risk as external factors likely affect interest rate, commodity prices, and investment values. The medium impact is due to the bank's robust risk management strategies, including hedging and stress testing, which help mitigate the effect of this fluctuation on the bank's operation. Thus, mitigation plan for credit risk is Public Bank can continue to apply strict credit policies, monitor credit portfolios, and maintain high loan loss provisions to limit defaults. For market risk, the bank also can continuing with the existing mitigate market risk.
Liquidity and funding risk at Public Bank is rated medium with a score of 9. The bank effectively managed this risk through its strong deposit base, liquidity buffers, and a diversified funding mix, which include both retail deposit and wholesale market. The bank also has contingency funding plans and conduct regular stress tests to assess its ability to withstand disruption. However, risk related to concentration and maturity mismatches could create liquidity pressure in the event of a sudden market shift or disruption to funding sources. So, to mitigate this, Public Bank will continue expanding digital deposit product, broadening its customer base for a more stable and diverse funding sources. Additionally, the bank will closely monitor liquidity ratio to ensure it remains well positioned to meet obligations under stress conditions, addressing any liquidity pressure promptly. Next, operational risk for Public Bank is rated medium with a score of 9. This is due to several factors. First, internal process and system failure can still occur despite the bank's strong control, as human error and system malfunction may disrupt the operation. Cybersecurity threats remain a concern as well. While the bank continuously upgrades its security measures, involving cyber risks are unpredictable. Additionally, external disruptions like third-party vendor failures or market volatility are possible, even though the bank has solid business continuity plans to address them. To mitigate this, Public Bank will focus on several key actions. First, the bank will strengthen internal control by incorporating AI and automation, which will help reduce error and improve operational efficiency. Second, frequent testing of business continuity plan will ensure the bank can recover quickly in case of disruption. Third, the bank will continue to invest in cybersecurity to stay ahead of evolving threats and protect customer data. Finally, Public will regularly review outsourcing arrangements to ensure third-party vendors comply with the bank standards and minimize external risks.
Under risk control self-assessment, also have a technology and cyber risk, have probability of 4 and an impact of 4, giving a risk level of 16, which is high. The status also high due to increasing and phishing, ransomware, and data breach in the banking sector. Greater resilience on digital platform, risk exposure, while regulators are placing more focus on cyber resilience. To mitigate this, we propose strengthening cybersecurity infrastructure with firewalls, multi-factor authentication, and instruction detections, supported by regular penetration testing and staff training. Next, capital risk has a probability of 3 and impact of 4. Resulting in a risk level of 12, also considered high. Although the Malaysian economy is stable, it remains vulnerable to global shocks and potential credit default. Mitigation includes maintaining capital above regulatory minimum and conducting a stress testing with scenario analysis. Then, the reputation risk show probability 3 and impact 3, with the medium risk level of 9. While the customer base is strong, the reputation is highly sensitive to failure or scandals, which can spread quickly through the media. Mitigation focus on strong governance and compliance, transparent reporting, and proaction PR.
So next, for strategic risk, based on probability and impact, the risk level is assessed as high, which also make the risk status high. This is because wrong strategic decision can lead to several financial losses, reputation damage, and loss of market share, which justify maintain a high level of risk. The risk is further elevated by rapidly changes market, intense competition, evolving customer needs, and high uncertainty surrounding by the bank long-term strategy. The best mitigation measure includes regular plan review, close monitoring of targets and action, and strong oversight of strategic policy. So, next, for Syariah non-compliant risk, the risk level is assessed as medium, which make the risk status also medium. This because Public Bank offer Islamic product but is not a fully Islamic bank, leaving room for possible lapse in compliance. Although Syariah government is in place, the growing demand for Islam finance in Malaysia increased the sensitivity of the risk, which justify keeping it at a medium level. As mentioned before, the best mitigation measure includes a strong system of internal control, effective business continuity management, adequate insurance coverage, and regular review of outsourcing arrangement. Next, for compliant risk, the risk level is assessed as medium and the risk status is also medium. This is because Public Bank consistently complies with the Bank Negara Malaysia regulatory requirement and international compliance standards. However, the possibility of penalties and reputational consequences in the event of breach prevent this risk from being classified as low. To mitigate compliant risk, the bank has put in place a strong system of internal control, effective business continuity management, adequate insurance coverage, and regular review of outsourcing arrangement.
For the risk control and self-assessment, Public Bank has rated climate risk as high. The justification is that climate change brings more frequent extreme weather events which can affect borrowers, lower asset values, and create pressure from regulators and investors. To mitigate this, the bank is strengthening its framework, integrating climate risk into governance and promoting green financing such as green property loans and sustainable investment. On the other hand, insurance risk is assessed as medium but high in importance due to the bank's expansion into general insurance. This increases exposure to underwriting risk, claims volatility, and stricter capital requirements. The mitigation plan includes strong capital adequacy monitoring and the use of reinsurance protection, which helps the bank manage large or unexpected losses effectively.
Okay, now I will present a public bank financial risk management practice focusing on 4 key risks. First, a credit risk is managed through prudent credit policies, strict lending criteria, and segregation of duties between the organization and approval, continuous monitoring and independent review, and adherence to credit policies ensure yearly intervention and proper management of exposure. Second, market risk addressed through portfolio analysis, sensitivity testings, and strict policies that require board approval. Hedging and strategies for exchange risk help keep exposure within the bank risk appetite. Third, liquidity risk is managed with diversified funding base and strong self-funding. Regular stress testing and contingency funding plan are integrated with recovery and continuity framework to ensure resilience during a crisis. Finally, operation risk is mitigated through strong internal controls, daily monitoring, and tools such as loss incident management and scenario analysis. Disaster recovery and continuity plan safeguard critical function and service.
For capital adequacy, Public Bank has consistently maintained ratios well above the regulatory minimum. The CET1 and Tier 1 ratios have stayed around 14 to 15%, while the total capital ratio has been stable near 17% over the past 5 years. Even though there was a slight dip in 2024, the levels remain far higher than the thresholds set by the Basel III and Bank Negara Malaysia. This shows that Public Bank is very cautious in managing risk while still supporting business growth. It also highlights the bank's ability to generate strong internal capital through steady profits, which builds confidence among regulators, investors, and customers.
Public has successfully kept its gross impaired loan ratio very low over the past 5 years, consistently staying below the industry average. This reflects the bank's effective management of credit risk and its commitment to maintain high quality loans. Even during the challenges of the pandemic, its loan loss coverage ratio remains strong, adjusting slightly due to provision for COVID-19 impacts, but always stay well above the industry level. The gross loan-to-fund ratio has remained stable in the low 90% range, reflecting a balanced approach to funding lending. Additionally, Public Bank shareholders' equity has grown steadily from RM47,248 million to RM57,335 million over the last 5 years, showing consistent growth. This increase in equity strengthens the bank's capital position, providing a solid buffer to manage future risks and reinforcing investor and customer confidence.
For valuation method of market risk, Public Bank use a cautious approach in managing market risk. The bank focus on sensitivity testing and portfolio analysis. Sensitivity testing is used to measure the impact of changes in interest rate or foreign exchange on income and capital. This allows the bank to estimate the extent to which small or large changes in the market can affect its financial position. In addition, portfolio analysis is done to see risk exposure according to business segment and asset type. In this way, risk can be distributed and maintained at a manageable level. Through a combination of sensitivity testing and portfolio analysis, Public Bank is able to assess a market risk more systematically and be prepared to face changing market conditions.
Public Bank manage market risk through a centralized system overseen by the ALCO and RMC. The bank use gap analysis, sensitivity reviews, and stress testing to monitor interest rate and rate of return. The Treasury Middle Office (TMO) ensure independent monitoring and compliance. These practices, combined with strict risk limits, help Public Bank maintain capital strength despite change in global and domestic markets. Public Bank applies the expected credit loss ECL model under MFRS 9 to value impairment on loans. The model follows a 3-stages approach. First, Stage 1, 12-month ECL for exposure with no significant increase in credit risk. Stage 2, lifetime ECL for exposure with increased credit risk. And Stage 3, lifetime ECL for credit impaired exposures. The ECL is calculated using probability of default, loss given default, and exposure at default. Public Bank also apply management overlays to address risks not fully captured by statistical models, ensuring prudence in an uncertain economic condition.
The management of operational risk is Public Bank highlight governance and internal control measures. The bank adopts policies from Bank Negara Malaysia and international standards to reduce risk from people, processes, and systems. This shows a mature risk culture that focuses on stability and customer trust. As the bank becomes more digital and expands internationally, operational risk will continue to evolve, especially in cyber threats and cross-border compliance. However, with its strong history of risk management, Public Bank is expected to remain resilient. Going forward, the bank may strengthen predictive risk analytics and automation to stay ahead of new threats, balancing innovation with resilience.
Okay, in conclusion, Public Bank's approach to risk management is comprehension and resilience. The bank maintains a strong compliance with regulatory requirements and show a solid financial standing, as evidenced by its strong capital reserve and superior asset quality. The bank successfully strike a balance between expansion goals and operational stability, protecting its reputations and guaranteeing a long-term sustainability by utilizing advanced methods for risk assessment and proaction strategy that tackle the current challenges.
In terms of recommendation, based on our forecast, the risks that are likely to increase the most for Public Bank are credit risk, market risk, liquidity and funding risk, operational risk, strategy risk, climate risk, insurance, technology and cyber risk, and capital risk. To mitigate this, the bank should deepen its strategy and planning through the integration of ESG and climate consideration, as well as more frequent stress testing for resilience. In practical terms, credit and market risk can be mitigated with better portfolio diversification and early warning system, and liquidity and funding risk require stronger contingency funding plans. Operational, technology and cyber risk can be addressed with regular system testing and staff training, and insurance risk can be controlled with robust guidelines and frequent product reviews. While Public Bank already has a strong framework in place, improvement in this dimension are necessary to prepare the bank for the challenge ahead.